Hi everyone, Nick here. Welcome back to my channel. High yield dividend ETFs are popular since they have been producing yearly dividends of 8 to 12% per year. People argue these funds are good for retirees or dividend investing, but I disagree. In this video, I'm going to answer 3 questions. How do these funds work? What's the catch? Or why I don't think these are a good investment? And what do I think is a better alternative? This video is packed with value that will help you understand and avoid possible mistakes of covered call funds. Best of all, this video is free. All I ask is that you smash the like button to support free financial education. My channel is all about helping you achieve financial independence. Make sure to subscribe so you don't miss future videos. These high-yield covered call funds are slightly complicated if you're new to investing. It requires understanding some basics about options. If you already know about options, covered calls, and so on, you can skip ahead in the video chapters below. An option is a contract between two people, and there are 2 types, a call option and a put option. Let's go into the details of a call option. The buyer of a call option gets the right to purchase stock from the seller at a fixed price, called the strike price. This agreement has an expiration date. Now, the buyer of the option doesn't have to buy the stock, they just get the right to buy. The buyer pays the seller a premium for this right. If the price of the stock goes above the strike price before the expiration, the buyer can exercise the option to purchase the stock for less than the present value. If the stock price never exceeds the strike price, then the buyer's option is basically worthless. This can pose a large risk to the seller of the option. If the price goes up and the option is exercised, the seller may be forced to go buy shares at present value, then sell them for less. The way around this is if the seller of the option already owns the shares when they sell the option. This is known as a covered call option. The seller may already have 100 shares of the stock and agree to sell those shares for a certain price in the future. They get a premium up front and may never have to sell the shares. This would make the premium pure profit, but they do risk losing out on the potential upside if the stock goes up a lot in value. This is what most of these high-yield dividend ETFs like QYLD, XYLD, RYLD, JEPI, and NUSI do. They buy shares of stock or underlying indexes, then turn around and sell covered call options to collect option premiums. By doing this, they have limited upside since a big rise in the price will likely result in the shares being sold at the strike price, which is likely less than the market value after they've gone up a lot. In short, these funds generate the options premium, have limited upside, and all of the downside in a crash. To protect against the downside, some of the funds will also buy put options, which is the right to sell their stock at a fixed price. This protects against the downside risk in a crash and is what the ETF NUSI does. I mentioned several funds that have YLD in the name: QYLD, XYLD, and RYLD. These are all from Global X and are cleverly named with YLD, which is short for yield. The first letter corresponds to the underlying stock index they buy in the fund. QYLD uses QQQ, which is the NASDAQ 100 index. XYLD uses the S&P 500 index. And RYLD uses the Russell 2000 index. JEPI is from JP Morgan and uses the S&P 500. NUSI is from Nationwide and uses the NASDAQ 100. If you want to learn more about the S&P 500 versus the NASDAQ 100, I made a video detailing the differences between these two indexes, which I'll link up here and below. Now that we know how these funds work, what's the catch? These funds are often said to be great for retirees that want a certain amount of income every month. Many dividend investors also like these funds. While these funds pay a large dividend, I think this misses the point. I'm going to use an example here, and it may not be perfect, but this is how I think of it. Whenever I've gone to buy a car, the salesperson at the dealership asks me, "How much do you want the payment to be?" I always thought this question was absurd because I care how much I'm paying for the car in total, the total value of the deal. The monthly payment can be lowered by extending the loan another year or a larger down payment. Many dealers can disguise charging more for the vehicle to less sophisticated buyers. I believe this is the same mistake being made with these high-yield dividend ETFs. People are focusing solely on the dividend and missing the total portfolio performance and some tax consequences. The goal of investing is to be able to pay your future expenses. It doesn't really matter if you get that money from a dividend or from selling shares. What matters is the overall risk characteristics and return of your portfolio. Let's look at an example in a portfolio visualizer using QYLD versus QQQ. This is for the NASDAQ 100 index. Let's say you retired the end of 2013 with $1 million and plan to spend $40,000 per year from your portfolio. To keep it simple, let's say you plan quarterly distributions of $10,000. We'll first look at two portfolios, 100% in QQQ, which is just the NASDAQ 100 ETF, and the other is 100% in QYLD, the covered call ETF that uses QQQ. We use 2014 since that's when QYLD launched. Since 2014, withdrawing $40,000 from each portfolio each year, we can see that the QQQ portfolio massively outperformed QYLD. The QQQ portfolio had an end balance of $3.5 million versus $1.4 million for QYLD. By investing in the NASDAQ 100 index directly, you would have received an average annual return of 21% versus just 8.4% in the covered call strategy with QYLD. Selling those covered calls missed out on a lot of upside. Even in 2018, when the NASDAQ 100 was basically flat, QYLD still underperformed. Well, how about risk? We can see the standard deviation for investing in the NASDAQ 100 was higher, which might mean it had higher risk. However, we can see the max drawdown of QYLD was actually higher than QQQ. The Sharpe and Sortino ratios, which attempt to measure the risk-adjusted returns, suggest that investing in the NASDAQ 100 was a more efficient way to take risk. Many people talk about how great it is to sell covered calls and collect premiums. I don't think the juice is worth the squeeze, whether you do it manually or through a fund that does it for you. There are many reasons for this, such as higher expense ratios, trading spreads, and the fact that this is more likely to cause you to market time. The biggest reason I think these funds underperform is since most of the market's returns come in just a handful of great days per year. A study from Fidelity covering an investment in the S&P 500 from 1980 to 2020 is shocking. If you missed the best 5 days in the market, it lowered your returns by 38%, while missing the best 50 days lowered it by 93%. And that's over 40 years, or over 14,000 days. Is it really worth it to have your shares called away when the market is performing best? Then you may be tempted to market time, waiting for the market to drop a little and miss another one of the best 50 days that delivered 93% of the market return. My next issue with QYLD is taxes. This is only an issue in a taxable investment account. Here's a chart showing the breakdown of the distributions from 2016 through 2020. We can see the distributions are very inconsistent and unpredictable. As a retiree, you want a more predictable tax rate. If you plan your portfolio well, you can manipulate your tax rate in retirement. Taxes can get pretty complicated, and I'll make another video on strategies for manipulating tax rates in retirement. Make sure you subscribe so you don't miss it. For now, I just want to point out this is an issue with these funds. This is important because different types of distributions are taxed differently. Short-term capital gains and non-qualified dividends are taxed like ordinary income. Long-term capital gains and qualified dividends have lower tax rates. A return of capital just means you're accumulating a capital gain in the fund and will owe taxes if you sell. For a retiree, your tax rate is probably going to be pretty low. For a married couple filing jointly, here's a comparison of the ordinary income and dividend or long-term capital gains tax rates in 2020. Keep in mind, a married couple can deduct $24,800, meaning you don't owe tax on the first $24,800 of income. In addition to this $24,800, you can earn an additional $80,000 from long-term gains or dividends and pay no tax. With non-qualified dividends or short-term gains, you have to pay the taxes immediately after your deduction, starting at 10% for the first $19,750, then 12% for the next $60,500. With the QYLD distributions being all over the place, you cannot plan as effectively. If you had $1 million in QYLD, there were a couple years where over 70% of the dividends were taxed like regular income. You would have paid a lot more in taxes those years. If you were to compare this to just holding a fund like QQQ or the Vanguard S&P 500 ETF VOO, those funds are basically all qualified dividends and they don't distribute capital gains. These other funds are very predictable. Their distributions are all in the favorable qualified dividend tax rate or long-term capital gains rate if you hold for more than 1 year and then sell. In short, investing in the underlying index is usually far better for tax planning than these high-yield covered call funds. Lastly, I want to show a simple alternative. QQQ and QYLD are not very well diversified. They primarily invest in innovative tech companies. While these may have done well in the past 10 years, the prior 10 weren't very good. Some other funds like XYLD use the S&P 500, which is far more diversified, but it is only US stocks. I think it is a mistake to only invest in US stocks, and for a retiree to have such a high exposure to stocks, especially a concentrated bet on innovation. After all, if you've spent decades working to finally retire, you don't need to take on so much risk. I have several videos that go into details on if you should invest in international stocks, risk tolerance, and asset allocation. I think you'll find all of these videos useful, and I'll link them in the comments below. I think a better alternative to these covered call funds is the 3-fund portfolio. The 3-fund portfolio is one of the most efficient portfolios when it comes to your time, taxes, fees, and getting one of the best risk-adjusted returns. The portfolio has exposure to over 11,000 companies globally in over 40 countries and over 10,000 bond issues. You can adjust the stock to bond allocation to meet your risk tolerance. I made another video detailing this portfolio, which I'll link up here and below. Let's use Portfolio Visualizer to compare a 3-fund portfolio with 75% stocks and 25% bonds versus XYLD and QYLD. XYLD is a more apples-to-apples comparison, since the 3-fund portfolio doesn't overweight innovation like QYLD. It's the same scenario as before, starting with $1 million in 2014 and withdrawing $40,000 per year. Overall, the 3-fund portfolio delivered a better return with less risk. This is what you want as an investor, especially as a retiree. The standard deviation of the 3-fund portfolio was the lowest. The Sharpe and Sortino ratios were the best, and the MWRR, or overall annual return, was the highest. The future won't always resemble the past, but you can evaluate it for yourself and see what's best for you. Thanks for watching, everyone. I hope you found this video useful. Similar to buying a car, when designing your investment portfolio, make sure to focus on the overall value, not just the monthly payment. If you got value from this video and want to support free financial education, make sure to like the video and subscribe. It really helps YouTube share this free content with more people. Later.